We got Charles McAllister joining us today. Charles is a CFP, CFA, CAIA. Basically, he's a money man. And the topic today is how to get rich or die trying. and how to stay rich once you're there. Charles, thank you for joining me, man.
Jonno, thanks for having me. I enjoy the topic for the day. I think it's a general one everyone feels about. I don't know. I hope I can add some value to that. Get rich or die trying. Yeah,
absolutely. So I think so for those of you who didn't understand Charles's title, which is actually something I wanted him to talk about, Charles is I don't want to insult you, but financial planner. Is that right?
Yes, I think. And I think you broached a very important point straight up front
which is my first question.
Yeah, it's the terminology in this industry. And believe it or not, Jonno, anyone can call themselves a financial advisor or financial planner. Yeah. I looked recently, because of having this conversation, on the requirements to become a financial planner for one of the life insurance is a matric, a driver's license, and no criminal record.
No criminal record.
Yeah, it's quite important. And one of the skills needed is sales. So with that type of requirements, you can understand the type of the individuals that are attracted to this industry. So unfortunately, the financial planning, wealth management industry does get a lot of flack. And the reason for that is because of the individuals sometimes they do join, and there's no regulation around terminology. So yes, I call myself a financial advisor because most people know what a financial advisor is. But there's various terms. There's financial advisor, there's financial planner, there's wealth manager, and on this end, there's broker. So there's a big push now with regulation to basically regulate the terminology, and they're trying to associate the qualification of a CFP, which is a certified financial planner, and only a CFP can call themselves a financial planner. So that's one of the things going through the process.
Yeah. So I know you've got CFP, which is certified financial planner. CFAs, what is that? A chartered financial analyst?
Yes, so that's very much finance orientated. So you don't need that to be a financial advisor. I find in my space I deal a lot more with let's say, financially astute individuals. So I felt that that's a qualification I needed if that's the space I wanted to be working in. And we deal with a lot of structures and a lot more investment orientated. So that was more my value add. But as a prerequisite, anyone looking for quality financial advice should be looking for a CFP professional, just because then that they have the competency, they've written exams, they've written board exams, and they keep up to date on an ongoing basis. So that's one of the things you would look for. Yeah.
Okay. So you're saying if someone calls themselves a financial planner, they could be a financial. It's like a coach as well. Like some coaches, don't. And so you could be a financial planner, but not a certified financial planner. And if you're a financial planner, not a certified financial planner, you might not actually know anything about finance, but you understand a list of products and how to sell them.
Absolutely. You've nailed it. So basically, if you, and I'm generalizing here, but you'll find it's generally the case, and probably something you would have experienced yourself probably. Someone's working for one of the bigger life insurers, they've been upskilled to sell a product.
Yeah.
So it's not identifying your needs, what is Jonno's needs. It's saying I have a range of products, and if I sell this product, I know what commission and fees I will generate on those products. So you can see there's quite a issue there, because you're not sure if the person who's giving you the advice or selling you something is doing so because it's in your best interest or in their best interest. And that's where the independence comes in. So that's always quite a big thing. Anyone engaging with someone in the financial services needs to understand, one, are you owned / controlled by someone? And sometimes you don't really know, who owns the entity, etc. And then the other question you should always ask is, how are you remunerated? Which is quite crucial. Is it a fee basis? Is it a rebate basis? Is it a commission basis? So that you can understand what you're in for. Now, don't get me wrong. I don't think there's anything wrong with a broker who sells product. But if I know that I need life insurance and I need 10 million life cover, I can find a broker then who specializes in that. And I know that he's going to go out there and get that for me. If I don't know what I need, I wouldn't approach a broker because he's going to sell me life cover, whether I need it or not.
Okay, that makes sense. So then you'd go for like an advisor. Is that right?
Exactly. You would hope to engage with someone who would understand what you are looking for. So sit down with you, understand your needs, understand your the future, your dependents, and then move from there and putting a plan together. So that's generally what the financial advisors or financial planners do. They base everything off of a plan. That's their value add, is the plan.
Yeah. No, so that's as opposed to just like saving, just willy-nilly saving.
Well, I saw that great term the other day. What's it? Saving is protecting your money and investing is growing your money. So I think where saving is something we should all be doing naturally. It's and we always, when I sit down with clients and I start right at the beginning, like, why do you save? Like, why do you invest? And the reality is that we have inflation. So whatever you have today, it's worth less tomorrow. Some countries have a lot higher inflation. So historically they've never had. So now they're starting to realize that prices actually go up more than 1 or 2% a year. And it's having quite a big knock-on effect. Whereas in South Africa, we've always had inflation. It's part of our economy. And that's why you invest, because you hope to achieve a real return. So you hope to achieve not just inflation, but more than inflation. So that's called a real return. So your money's not going backwards every year, and your money is growing in real terms. That's why individual invest.
Well, so let's talk about that, because I think this talks a lot to the point that you have about like bad financial planners. And when I was at my the last job I had an endowment policy. I think it was like a 5-year plan. And at the end of the first period, I got a report back, and I'd contributed 17,000 Rand. But at the end of whatever period it was, I can't remember what it was. And but at the end, my net, the fund had actually made money. So like it had made X% improvement in the value of the fund, but my net at the end of the year was only like 15,100 Rand. So even though I'd invested the money, I'd still lost almost 2 grand, which was like 15% or something of my investment.
Yes.
More. Yeah. So what like that's so the question is, how do you expose some of the truths about fees?
Well, to be fair, I'd almost be standing on the shoulders of giants with that, because there has a lot of work with fees. And what I mean by that is, think back to when 10X was launched. 10X is the passive company.
Stephen Nathan,
Yes, in 2007, 2008, they did a huge amount of work around fees in South Africa. And they had fantastic marketing campaigns. And the reason they're there, because the individual was paying 3.5% on their pension fees. Now, keep in mind, I said you need a real return, So if inflation's 7 and your fees are 3.5%, just to not go backwards, you need to earn 10.5% a year. Yeah,
and just to be clear, that's 3% on the capital. 3% on your monthly contribution.
Correct. That's on the capital. So they did a lot of exposure around that, and slowly but surely, there's been a lot of changes in the industries where people are becoming more aware of fees. They never used to really ask, but they're becoming a lot more aware. And a lot of work was done with 10X and other players in the industry where they showed what does 1% over 25 years equate to. It's something like 50% of your income. 50% more capital at retirement time. So that's quite a big number. I mean, the problem with us as humans is we don't actually think or take into account that far ahead. But that's a huge number.
Can you just go back and say that again? So you're saying if you pay 3%, what is it, a year on the capital amount over 40 years, that can work out to be like the difference of 50% of could have taken away if you weren't paying that.
Your actual end capital, So not if you save 1% in fees.
Yeah.
And fees is very important. I'll explore it more now, because fees is essentially a negative return.
Yeah.
So if you've got a 2% fee, it's a negative return of 2% on your portfolio. So if you can save 1% for 40 years, the compounding effect means you'll have essentially, I think it's about 40% more capital. The numbers are all there. It's huge. Exactly. 40% more capital. So that's why we quite cognizant and aware of fees. And it's something that we drive quite hard with clients, because 0.5%, 1% saving a year is adds up quite dramatically. And the problem with fees is there's generally always 3 levels of fees for investors. no matter where you go, sometimes they put it together and you don't see it, but there's usually three. One is the administrator. So that's the company that houses your investments. So if you go to an Allen Gray, they have a LISP. They've got an Allen Gray platform, and on their platform, you can access Allen Gray funds, Coronation funds, FIRD, a whole range of funds. They charge you an administration fee. And that fee is to do reporting, report to SARS. Sometimes it's in a wrapper. It's a tax-free savings. And there's other work required there. So that would attract your admin fee. And you see that fee. You see it on your statement, admin. Okay, happens on a monthly basis. And it's usually a scaled fee. So the more you have with them, the lower the percentages, which is great. They're going in the right direction. Then you'd have your financial advisor or planner fee, which is generally an ongoing fee. So what's generally standard in the industry is a 1%. And the reason it's 1 is because that's the most actually you can take regulated on an ongoing basis. A lot of planning practices can usually reduce that based on the quantum of funds they're dealing with. That's a fee you also see on your statement. So you'll see it being deducted on a monthly basis. So 1%, I think it's 0.83 on a monthly basis gets deducted. So your advisor's earning more as the market goes up and less when the market goes down. So the argument there, the interests are aligned. The advisors need to grow your wealth. I mean, we can talk about more of that later. So those are the two that you do see. Then there's actual fund fees. So the actual investment you earn has a fee inside of it. And this is called the TIC, the total investment cost. And that is built up of the manager's fees, transaction fees, taxes, and everything. And they're bundled together. They call it, that's a do not see.
Yes.
You don't see it. It happens within the fund. So when the fund says, oh, we returned 10% last year, what actually happened, if it's a TIC of 1.5, they returned 11.5. So that happens within the fund.
Okay, but they're not lying. So it's not like they say we return 10, but actually you only see the upside of 8.5.
No, so they would say we got 8.5 last year, but the real return was 10 and 1.5 as fees. But what I realize is when they look at the value chain, they might concentrate on what they do see, but they don't think about what they don't see. And that's where you got to look at all the fees along the way and go, right, where is my biggest fee leakage here? That brings other topics of active management or passive and fees. But to go back to your scenario where you had an endowment, this is a specific savings vehicle. And it's a very powerful vehicle if you're a high income earner because it has a lower tax rate. Okay. But you can also set up, it gets sold with monthly contributions. So whether it's being sold to you, you're forced to save into this thing. And if you stopped it within the 5-year term, it comes with a term, some push it out to 10-year, then you carry the penalty.
Yeah, I think I did pay a penalty.
Correct. And that penalty is the commission that was paid up front to the individual who sold it, the marketing, the administrator. And that sometimes can be quite, it's quite out of proportion to the work done. This guy, I don't know, sold it to you. I'm generalizing, but maybe it was an hour in a coffee shop, sign a piece of paper. You didn't really know what it was. And that then generates commission that sometimes is up to a year's worth of contributions.
Yeah, wow.
So that's why you would have seen a lot higher fees in something like that, because that's an insurance fee deductions. So I'm not saying it's bad. I'm just saying sometimes it's not really appropriate for the individual. And there's a lot of argument that comes up because I'm against commission personally. But there's a lot of discussions in the industry where they go, well, actually, commission is quite important because these vehicles force people to save. Because there's a penalty that forces them. And that industry actually attracts billions of savings every year, which is a good thing for the economy. People are saving, they're buying government bonds, they're buying shares, they're buying all those things. So it's a bit of a dual debate on that. But I'm not the biggest fan of commission because I feel that sometimes it's not disclosed or understood.
Yeah, that's fair enough. So you mentioned active versus passive, which is one of my favorite topics. So you want to talk about that?
Sure. I think that it's been talked about to death, but I mean...
Maybe explain passive and active first before going into the...
Well, an active manager wakes up every morning, he looks in the mirror, he beats his chest and he goes, I could beat the market today. I'm smarter than everyone else out there. I know which shares are going to win and which shares are going to lose. that's basically to really simplify it. And that's what active management is. It's basically someone going, when you hear the news in the day, they say, oh, the JSE is up 2%. But what does that mean? There's a measurement of the JSE, and that's the index. So basically, it's how they measure the movement. They compile an index of shares based on market weighting or pricing, depending on which one you look at. And they say, great, as a market, a reflection of the market, it's moved 2%. Okay. An active manager is saying, well, I can do better on an ongoing basis. And so they have research analysis, lots of analysts. They have a whole team to analyze things and look at things and make decisions. So basically, they're saying, we're going to do better than the market. Whereas a passive goes, I don't want to do better than the market. I just want to do the market. And usually in a passive solution, it means that it's aiming for that index return less the fee of whatever that fund is.
Yeah.
So and usually those fees are low because there's no active work required. You don't have to pay 50 analysts offshore lots of money because you just follow a formula. And historically, over the last, there's a lot of research on this in the US because that's where a lot of passive active debates take place, and there's a lot more volume of trades. But on a historical basis, when you start pushing out the time frames, most active managers struggle to beat the index.
Yeah. Is
most,
it 4%?
And when I say most, no, it's something like 90% struggle to beat the index after 5 years. Now, the stats change. But that's a huge number over the long term. And then you've also got recently this last year, last year was a tough year for markets and offshore markets are down quite considerably. So active managers got quite excited because this last year, 60% of us outperformed the index. And that's the first time it's been above 50. So it's basically a coin flip. It's been above 50 for 10 years. So the argument there is when the markets are falling, that's when active really provides, but they haven't really done that historically. So, and this is a numbers thing, but if you're doing average, you're consistently doing average in investing, it means that in the long term, you're going to be top quartile. What I mean by that is you're going to have the top 25% of returns across the industry if you just do average every year. And you can see that because a lot of these popular fund managers, one year, they all have a theme or a story, and one year they're doing great, and the next year they're doing poorly. And it's just this cycle. So all I'm saying is, or with passive, you're going, I don't want that cycle of volatility. I just want that average. So I'm never going to outperform the market, but I'm never going to dramatically underperform it. And I'm happy with that. And that then, exactly. And that then reduces fees. Which is because it's a lower cost solution. So straight away, and as I said, a fee is a negative return. So if you're reducing fees over the long term, you're going to be generally better off. Now, there's some segments where you do want more active managers, and that's in spaces where maybe the markets aren't as efficient. But offshore, you're probably fine choosing a passive solution. And once again, in South Africa, there's actually been a lot of work on passive solutions, from 10x to Signia to core shares, all ETF or passive providers, and which is quite interesting because globally, most industries or asset managers have been forced to change to passive because of regulation, and that's when I talk about commission. When they cancel commission, everyone goes passive. It's quite interesting. Because there's no incentive now to sell the story. And that's the thing which most people don't realize. The investment industry, we've got a very strong, long investment history in South Africa, but they are set up to extract as much money out of their clients as they possibly can. They're not there to put the most cost-effective best solution. And unfortunately, then you get the scenarios where there's a lot of mistrust for investors, and they're never sure, because this industry is great with creating not confusion, but not 100% clarity or transparency on things. I mean, you don't know the different investment strategy between Allen Gray balanced, Coronation balanced, PSG balanced, or Prudential balanced. You don't know. But at the end of the day, they all do the same return over 5 years. It's like 1 or 2% difference, but they all got these lovely stories about who buys in a value or who's a momentum or how many analysts they have, because that's generally what happens in this industry. They get told a lovely story. It's exactly, it's marketing. You arrive in Cape Town, who's plastered all over the wall in terms of marketing. You think,
Yeah, so that's, I mean, Stephen Nathan was actually, so when Stephen Nathan launched 10X, he actually came to the company I was working for, and he got us off that momentum fund and sold us 10X. And he gave a presentation.
Well done. Yeah.
And he said that, if you want to know which funds not to invest in, which companies take the highest volume of your money, it's the ones who can afford to put adverts on TV.
Yes, exactly. The ones with the biggest marketing budgets.
Yeah, the ones with the biggest marketing budgets. So there was one more thing. I just want to go back. Like you said over 5 years, I read a stat about beating the market. And apparently in the States, it's 4% of traders beat the market over 20 years. So like... Yeah, and so every like all the adverts that I've seen that you're talking about, they say, the best fund in this category for 3 years, or the best fund last year, and you'd have no idea what they said like 3 or 4 years before that. But last year they won. And
you'll find these investment houses have 10 different funds in different categories. So every year they'll have a winner. Whether it's the fixed income fund this year, it's the offshore fund, or it's the balance fund. So they always market that winner. I'm being very facetious, but I mean, that's what you'll notice when you actually start paying attention to these things. So that's why the argument for passive is so strong. You're going, okay, I just want that, and with passive, we're going to achieve what we call beta, which is your market return is beta, and the active managers believe they will deliver alpha, which is an outperformance of beta. So. To maintain your lifestyle, you aim for beta. And with my clients, when we talk about these things, we say, how do you achieve alpha? You might do it in your personal capacity trading, or a lot of entrepreneurs will achieve their alpha through their businesses. You're not reinvesting in your business has a much higher ROI than a lot of the time in the market. And that's why a lot of entrepreneurs do put a lot more back into the business.
What is the difference? You once told me about actively managed passive investment strategy.
Yes. So in that scenario, because they're all passive, there's a slight element of active to the point where they have to make the decision of what to choose.
In terms of which passive funds?
In terms of what index, for instance. So
index is not a fund, is that right?
No, it's not a fund. It's not a fund. Exactly that. It's the index that they're tracking. So you got like Satrix has the S&P 500. So that is an index that you can buy, and it just tracks the S&P 500. Fairly simple. There are funds in South Africa which put together different ETFs or indexes within the fund, and that's an active decision. There's a rule around it. So a great example, Nedgroup have a core fund where they have equities, they'll have equities, bonds, property in South Africa, and then offshore they'll have equity, property and fixed income. And locally, they'll just track the SWIX, and globally, they'll track the MSCI World. But they have to make a decision. So when they built that fund, they need to make the decision, which index do we want to track? And then what weighting do we want, which is quite important. So just to get a bit technical, for instance, there's in South Africa and our pension funds, they're regulated by something called Regulation 28. And that restricts how much they can have in certain asset classes. And that's to protect the investor. So it's basically saying you can have so much in equities and you can have so much offshore. This has been a huge debating point for a lot of investors, advisors, and a great marketing where they say, don't save money in your RA because you can only have so much offshore and you're stuck in South Africa. But what's actually happened on the ground is, as investors, we've been able to take more and more money offshore in our pensions. Historically it was 20%, then it was 30%, and now it's 45%. So almost half of your savings you can allocate offshore. So that Reg 28 dictates that, and a fund like the Nedgroup fund, when that's changed, they had to make a decision. So that's where I talk about active. They had to go, do we change our offshore currently is 30? Do we shift up to 35? Do we do 40? In their case, within a week, they just turned it all 45% offshore. But they had to sell something locally. So that's what I mean. There's a bit of active to that, just deciding the rules. And once you've got the rules in place, it just keeps going on a rebalance on an ongoing basis.
Well, going and sending that money offshore is a huge topic at the moment. And so there's a lot I want to ask you about South Africa and money in general. But let's just talk about like the main thing. Like when it comes to sending money offshore, what should we be looking at? Where should our heads be at with that?
It's a very good question, because the reality is we don't live in the safest postcode when it comes to your investments, and it is a huge topic for various reasons. One is generally investing offshore means you have a much larger market to invest in. I was reading the stats the other day. I think the GDP of California is like the 5th biggest GDP in the world compared to other countries. It's bigger than France, Germany. And so to wrap your head around that of the size of, never mind just a state, but a size of, of companies that are bigger than South Africa's economy. And to get exposure to that, you have to, invest offshore. So there's that argument to it. The other argument, though, is a geographical risk. And they're saying, well, if you're in South Africa, there's a rand weakness. There's a lot of talk sometimes about property rights, i.e. do they force you to save a certain way in your pension? There's a lot of narratives around that. Is your money ever safe? Because we have a lot of fear living in South Africa naturally. So when we look at it, we look at it more slightly that it needs to meet your planning requirements, because the reality is going offshore isn't the be-all, end-all. The best asset class to own. Remember when Nenegate happened, and that finance minister for the weekend, and we all watched the rand just. I think it got close to 16 to the dollar at that stage, but it depreciated dramatically. The best asset class to buy straight after that happened was South African bonds, because our yields were high and the rand was weak. So in dollars over 5 years, the best performing asset class was South African bonds, because the rand strengthened and our bonds came back down. And that's the thing. South Africans get very reactive when the rand's weak. And I always never understand why. Are you going overseas tomorrow? Like, why? Or how does it affect you that it's 18 to the rand? Because I can tell you now, all those farmers in series are ecstatic that it's 18 to the rand, because they're exporting. So anyone who's exporting is ecstatic, and the export grows our economy. So I always try to understand the psychology around it for individuals. And it's obviously our fuel's slightly more, but South Africans, almost their happiness index is linked to the rand, when sometimes that's not necessarily the right thing when you think about it.
Profound,
and you look around. No, it really is. Like, guys are depressed when it's 18, and I remember COVID, we hit 19, 20, and then we came all the way back down. And that's the thing. The rand's very volatile. Don't get me wrong. There is baked-in depreciation on an annual basis, and it depends what time frame you look at. But on average, it's about 5% a year. Over the last 10 years, it was slightly more aggressive because we had a much lower starting point. But the reason our rand does depreciate is because of inflation differentials. So what I mean by that is that, like I said, in a country like the UK, they've never had inflation. So my mates working there, every year they get a 2 or 3% increase on their salaries. Whereas in South Africa, you're getting 7 to 10% as a professional, just in an inflation increased job. So something needs to keep that balance. You can't have South Africans earning dramatically more on a pound or dollar term, and then what keeps that balance is exchange rate. So the exchange rate is a shocker to keep that balance on inflation. Okay? And let's think about it. 8 years ago, I was in London watching rugby, and I was paying 24 rand to 1 to buy a beer. It was 24.
Wow.
And do you know what the pound is now? It's 22 rand. It's 22 rand.
Okay.
Yeah. So
24 rand.
Yeah, this is 8 years ago. So the rand is not a depreciating currency across the board. That's a narrative that gets pushed at you. And people always pick the dollar, and they pick the US market. The US does make up 65% of the global investment market, but it's not the only market. And that's what's quite annoying. You got to be very careful, because remember, it's marketing. Everyone has their story, and they play on emotions a lot of the time. So yes, we do have a depreciating currency, but there are investment opportunities in South Africa where you get compensated for that depreciation. And that's why it is such a big topic, because there's no wrong or right answer. And depending on the time frame you pick, you'd rather be in South Africa than overseas. During COVID, there was a lot of fear when we were at 1920, and everyone was like, move your money overseas and buy biotech stocks or whatever it was. That would have been the worst decision you could have made. The worst decision. Even now with the rand at 18, because our market had come back so much, and COVID, I think we dropped down to 30,000 on the JSE, and we finished Jan at 80,000. So there was such a huge recovery there. Wow. South African assets are on sale. There's a lot of the value in the very strong companies we have in this country. But when we look at it, we look at individuals. In our practice, we generally deal with high net worths. And in that scenario, because of the investment opportunities, they have anything from 60 to 70% of the assets outside of the country.
Okay.
So I think there's an important topic to get onto while we're on it. There's two ways to get exposure to offshore investments.
Yeah.
One is through something called a feeder fund.
Yeah.
So the fund is in South Africa. It feeds into an offshore fund. Great examples of that are like Orbis. Orbis is the Alan Gray's offshore equivalent. I've got some Signia stuff, which is local and it feeds to the offshore. Yeah, so that's called a feeder fund. So you can get the offshore exposure, you get the rand hedge because you have the assets offshore. But when you disinvest, it has to come back to South Africa. Okay. So it always comes back to South Africa. So that's a feeder fund. And what sits next to the feeder fund is something more technical called an asset swap, where a company will take your money, swap it to dollars. You can invest it, but when you disinvest, it always comes back to South Africa. So that's the one channel to get what I like to call offshore exposure. You're not getting an offshore geographical location, but you're getting your exposure. Then if you want to, then the other arm is, the other point of this is where you physically remit money out of South Africa. And that's where I generally say to clients, you want to be physically remitting money out of the country if you want to be investing offshore, because it kind of ticks your geopolitical risk box that you're worried about. And in South Africa, we still have exchange control. Which kind of regulates the flow of money in and out of South Africa, which has saved us a lot in the past when we've had banking crisis globally. And it's another fear thing. People always say, oh, they're going to stop exchange control. You have to bring all your money back. There's a lot of narratives which tugs on those emotional strings. But the reality is in the current regime, you've been able to externalize 100% of your wealth. Wow. You can externalize every cent tomorrow if you wanted to. Okay. So, and historically, you weren't able to do that. And this is another interesting point, because I remember when I started remitting funds offshore for clients in 2008, you could only move 750,000 Rand in your lifetime. That was the restriction. Wow.
And then it became like 10 million at one point.
So they went 750, it hit 2 million, it hit 4 million. And when it hit 4 million in your life, this is still lifetime, that was when the Rand was 6.50 Rand to the dollar. It was after the whole world had gone through a crisis and we were having a commodity boom. Zuma was still in charge, and the Rand was 6.50 Rand to the dollar. And people always point to that as their benchmark. And I'm like, I don't know why. You could only ever remit 4 million during that period. It's not like you were able to take everything offshore. And then it moved along the way. And now, as you know, it's 10 million a year plus your 1 million travel / discretionary allowance. So the 1 million is, you don't need to do anything. You can do it tomorrow. There's lots of apps where you can buy currency or transfer it offshore to virtual wallets. So it's 11 a year. But if you wanted to move more, and of course, if you had the money to move more, you could do something called a special application. And a special application is you go to SARS, you say, hi, I want to move 100 million Rand offshore. I have the 100 million Rand sitting in my bank account, and SARS then do more of an additional DD on you. So they kind of do a mini audit and they give you an approval. Go for it.
So you don't have to pay like a whole bunch of extra tax. They just say, yes, you may. Yes, you may.
Exactly. No, go for it. They say that it used to come with 2 restrictions. One of it was every year you had to report to the SARB where the money is. And secondly, you couldn't put the money into a trust. So they dropped the trust restriction recently with loop structures, etc. And they're definitely going to drop the reporting one, because with the Common Reporting Standard, CRS, the whole world is sharing information. So SARS knows where your stuff is. So the reporting one will fall away in due course. But ultimately, you can externalize your entire wealth. So that's quite, I mean, when the narrative is like, oh, we're on trouble, they're not going to let us take money offshore, but we can externalize it, and there's no penalty. Because historically, if you wanted to move all your money offshore, you had to immigrate.
Yes.
It's another wonderful topic. You had to immigrate, and then you had an exit levy of 10%.
Yeah.
So everything you took offshore, remember Mark Shuttleworth? He brought all his money to South Africa. Then he took it offshore, and he actually paid a 10% exit levy.
With like a couple billion rand.
And he actually, and the real ouch was actually the next year, they dropped that immigration exit levy, and they allowed you to take your money offshore. But he took the Reserve Bank to court, and I think he won.
I'm sure he'll be okay, though. Either way.
Yeah, exactly. I mean,
he'll be okay.
So externalizing it, there's a price, etc. But I mean, it's not that challenging because most people use their million every year. And then you don't need to go through SARS, and any investment house or any foreign exchange company can help you physically move it offshore and then invest offshore.
Yeah. So last topic before I get into some more like stuff around cash is the rent versus buy, and then like buying in general in South Africa. So people are just not wanting to buy a property here because I think everyone's on high alert that if things go, to be able to drop and roll, get out of out as fast as possible. Are you? Yeah. What is your opinion on that from a wealth perspective?
Well, it's a very interesting topic because a lot of people have generated a lot of wealth from property. So there's been it's been a big wealth creator historically. But recently, when you start actually looking at this, like really looking at the numbers, owning property as an investment is not as lucrative as it used to be. Rates up, levies on units are ridiculous now. You got tenants issues. So the returns. So there's two elements we're talking about here: investing in property and buying your personal property in your home.
Yeah.
You're quite right. I think we have to acknowledge that there's a big difference between Cape Town and Joburg.
Yeah.
So where you live is a big drive. So if we think about Joburg which historically Joburg's always had a great yield. So what I mean by that is you buy a unit for 2 million, you could rent it for 15,000 or 12 to 15,000. So the yield on your capital was generally quite good in Joburg. You didn't have that capital appreciation. So what I mean by that is it wasn't growing 10% a year, your 2 million property. And the reason for that is obviously Joburg's nice and big and flat, and they just build a new suburb down the road. They built Stain City and Waterfall City, whereas if you look at something like Cape Town, you've got an ocean, you've got a mountain, and you've got so much land, and that's it. So Cape Town's always enjoyed capital appreciation, but the rent and as such, your rental yields have been lower. So the same, especially now, the same 2 million flat in Joburg, you're probably paying 4 million in Cape Town, but your rental yield then is lower. It's an investment vehicle. You got to just acknowledge that aspect of it. So if you were buying it the benefit of buying property as an investment vehicle, and this is residential, is the gearing. Whereas you use the bank's money. So you only put down a deposit of 10 or 20%, and then you gear your return. Cape Town historically was great because you had this fantastic property boom on the price range, and that was a geared return. And you could offset a lot of it against the rental income tax. But things have changed quite dramatically. Even with everyone moving to Cape Town, there's still the costs, the levies. I think of my rental properties, we have a portfolio, and it's, besides the tenant issues, just the costing is doesn't make sense anymore. And especially on interest rates. So you have to acknowledge when you buy during the cycle is also very important. So I had friends who bought at the dip of COVID. What I mean by that is the low interest rate. And this was, I think, prime has gone up 3.5% or 4% since then. Let's just use 4% is the round number. So if you bought a 3 million rand property asset, are paying 120,000 rand more a year just on the interest rate increases for that 4%. That's 10,000 rand more a month. And if you didn't budget, because most people don't, most people stretch themselves when they buy a property, right?
Yes.
They go, this is the one I want.
The biggest thing you'll ever buy.
Myself. Exactly. And there's lifestyle creep, as we know. So you want the nice house and the nice suburb. and then interest rates go up 4%, that adds an enormous amount of mental stress to a family in terms of having that debt, and disposable income disappears. So that's why I say it's quite important when you talk about timing the cycle as well. So that's on the not only the investing side, but also buying your own property. And I look at the merits of, if you were buying a 5 million rand house, your bond now is what, 40,000 rand a month. And if you are renting a 5 million, you'd probably be able to rent at 20 to 25 a month.
Yeah.
So you got to look at that. Obviously, there's a lot of people moving into Cape Town, so finding rental property is a challenge. But there's still, there's still very much a discount to a renter. So the argument there is, well, if you have the discipline to save the difference,
yes,
then renting is not a terrible option as long as you don't want to make changes. But renting is not a terrible option because there's various things you don't have to worry about. When there's something happens to the geyser or something breaks, it's the landlord's problem.
Yeah,
you don't worry about the rates. You don't worry about the costs associated, the maintenance. If you're spending 3% on maintenance on property a year, it actually also adds up quite a lot because you have to look after the asset. So renting, and then of course renting, you've got a home office. There's a tax that you can work on in terms of expenses on your tax returns. Various elements where renting makes sense. But I would say if you're going renting your primary residence, you need to make sure that you're at least on the property ladder. Yeah. So what I mean by that is that you have exposure then to an investment property. And then it might not be a 5 million rand one. It's a 1 million rand flat where you're comfortable with the bond repayments if you don't have a tenant, and you're kind of in there. So if the market does run away from you, i.e. property prices go through the roof, you at least have that exposure to get that appreciation. And then you wanted to buy a house, you'd sell the rentals, pay your taxes, and put that towards a property. So it is, and that's why I say it's important to see what part of the cycle you're in. Yeah. As well as where you are. At the moment, we know in Cape Town, it's a seller's market and there's not a lot of property stock.
Yeah, it's unbelievable, actually. It's so hectic.
I mean, I don't think you can find a rental property in the southern suburbs. You literally can't. So it's very much a seller's market. The rental demands are quite high. And I mean, just me, I saw with my properties, I think the rental escalation from last year, which still had legacy COVID rental, to this year, it wasn't an inflation. It was like a 15% jump because of the demand is there. And the tenants are correcting almost. Yeah, it's corrected and caught up quite a lot.
Yeah, well, I mean, I suppose it's promising for the Western Cape just in general, but sad for the locals who live here.
Yes, and I mean, I've had this regularly with individuals, and if you think about it, how many foreigners are buying properties along the Atlantic seaboard? Now imagine that South Africa didn't have load shedding, and we were a lovely, safe, economy, and you and I wouldn't be able to afford property ever because it's a beautiful place, and everyone would be buying property here.
Yeah, it'd be an agent or something.
Yeah, exactly. We'd struggle.
I had so much more I wanted to ask you, but I know we're out of time. So I think maybe you can do these.
We might need a part 2. Yeah,
we'll need a sequel. But there are 2 questions which may tie each other. The one is, how much is enough? The other is, what do you wish we would be teaching? What do you wish What do you wish we would all teach our children about money?
Okay. No, they're good questions. So how much of it is enough? I mean, people write books about this. How much is enough?
You gave me the one that says, how much is enough?
Exactly. And the reason we do that for clients is because that's such a good question where as investors and savers almost put too much stress on themselves. And they don't understand their expenses and their asset base and the growth. So the how much is enough question is a great one. And I hate to give you this answer. It's dependent on the individual, naturally. So if you got a family of 3 and you live a more let's say you live overseas regularly, and in retirement that you still want to be very active in certain areas, you're going to need quite a large asset base. Because that asset base needs to generate income to sustain your lifestyle. And the topic of how much is it so should be looked at, well, what do you use to generate your income? As an entrepreneur, you might still have shares in a business, you might have a pension, you might have property. There might be various channels that generate your retirement income. And that how much is enough question is more along there's various elements to it, but it's like how much risk will you be taking? As in, how much will you be investing in certain asset classes like equities? How much do you, how long are you working for, and how long will you be in your drawdown phase? And that is actually a huge impact. Just by working another year, that's 1 year of more savings, 1 year less drawdowns, and closer to death.
Yes.
So it's quite a big working longer. And I'd like to think we're still young, late 30s, early 40s. We're not going to be retiring at the age of 55, sitting back and playing golf. We're going to be living longer. So we're already in that lifestyle of work play, or the balance. We going, okay, we want to continue doing this to the age of 70. So I have a slightly different outlook with how much is enough, because it's more also, well, how much longer will you be working for? Some people almost never stop working. And I've got clients who've had phenomenal experiences post-retirement. What I mean by that is they've gone into other careers or started new businesses post the age of 55 and have been wildly successful in that. And that's the thing, where if you now are focused when you hit that retirement stage, there are opportunities to generate income. So if you say to me, well, actually, I don't want to earn another cent and I want to stop working at 55, you need a lot of money. Because inflation will erode your purchasing power. So you need a lot of capital to start with. And a lot of the rule of thumb, it's like only draw 4% of your income. The rules, there's some research behind it. But if you think of it that way, if you need to generate $500,000 a year, then you need to have close to 25 million rand at 4%?
Jeez.
Or that's 2%. 10 million. So you can use the 4% rule that way to kind of calculate what you need. And then, of course, there's tax. SARS also takes tax when you draw income. So the how much you need is a lot of factors in there. But one of them is I would sit down and go, well, how long do I think I want to work? And there's lots of other things you need to take into account, like if you stop working early in terms of aren't able to, do you have disability cover, life cover? I think with you historically that graph with your human capital versus financial capital, which is quite a powerful image, but I think maybe that's another conversation point. But that also plays into it. On the education side with kids, and it's a big challenge. We both got young kids, and my son's asking me for Robux. So he doesn't, his pocket money, he wants to buy virtual money. And for me, that's quite a
there's a barrier. What is Robux? What is Robux? What is a Robux?
Robux is the currency they use in Roblox. Roblox like Minecraft. And you buy that currency, and then in the game he has these awesome Nikes, and he has a hoodie and his Adidas cap, and that's his avatar. His avatar has bought all these things. I think Nike predicted that 20 or 40% of the revenue is going to be coming from the virtual world in the next 10 years.
I don't even want to comment on that because I might sound hostile.
This is what I'm getting to. So
horrified. I'm horrified.
Well, let's be honest, Robux is probably more stable than the Rand. So in terms of holding it as a currency, it's not a terrible thing.
At least the manufacturing and delivery costs aren't affected.
But this is where it's quite hard because we all have kids. And for me, it's teaching that value of money is I don't have all the answers, but it's being very open and transparent on it. And I think delayed gratification that I try to teach them now at younger. Yes, you can buy that Lego with your reward charts because you get 300 Rand towards a Lego. But if you have 3 reward charts, you have close to 1,000 Rand towards a Lego, or whatever it is. So it's that building up and compounding. The one thing, not about teaching, but the most powerful thing you can do as a parent for your kids is starting a tax-free savings account for them.
Yeah.
There's a lot to talk about on that, but that tax-free savings, if you maximize that every year for your child at 36,000 Rand, and they don't touch it until they hit the age of 50, because, at 18, they can technically, they become the owners.
Yes.
They will not save for retirement. They won't need to save a single cent.
Wow.
And that's from compounding and the fact that you draw tax-free. And there's no investment restrictions around it. So the most important thing as a parent you can do for a child is a tax-free savings. And then I find that educating children, i.e. bringing them in and exposing them. This is what we have for you. Why do we have that? What is the approach there? And you see this a lot with wealthy families where they get very concerned that the next generation will be, well, I hate to use the word, but entitled. They won't appreciate it. And I always say, well, there's nothing you can do but educate them. You need to start early and young. Why do we save? Or if your child's a beneficiary on a trust, why do we have the trust? What is our family ethos around saving? Do we have charities that we contribute towards? So the education is quite crucial at a young age. And also, if you're giving pocket money, or if there's some sort of monetary reward on a regular basis with your child, do it physically. A card and a tap. Kids don't see cards when they tap. They don't realize what's actually happening in the background. So to actually have money and counting it is that, at least bring that back into it, the physical money aspect to it.
Yeah, that's gold. Charles, I know you got a kid's birthday party now, and
well, I actually have load shedding in the next 5 minutes.
No kidding.
That's the other challenge.
Yeah.
Yes, exactly. Yeah.
But awesome. We're going to have a sequel, but enjoy the rest of your day, and thanks for joining me.
Yeah, only a pleasure. I think we scratched a few topics there, but I think we can definitely go into a lot more with maybe profile of individuals who are accumulating wealth, what should be looking for. But it was highly enjoyable. Thanks, Jonno.
Awesome, man. All the best.
Yeah.
Cheers.
Great. Thanks. Cheers.